Well, thank you, everyone, for coming to this episode of Loan Risk Advisors Compliance Rundown. Today, we have as a guest Champ Farrar with an explanation on more marketing compliance. If you recall, in a prior episode, Champ chatted with us about team names in marketing, and I really thought it went well. I wanted him to come back on more marketing compliance issues. So today, we're going to talk about firm offer of credit. So, Champ, thank you again for coming to the podcast and sharing your knowledge, wisdom, experience, scars, and mistakes we've all made, whatever. I appreciate it.
Yeah, thank you for having me. I'm glad to be here.
Now, I want to kick this off is firm offer of credit, just kind of high level. You can tell me how you navigate this, how they navigate these before. A lot of people did. And it can sometimes be frustrating. A firm offer of credit, just in the grand scheme of things, is a form of lead generation. And a pretty, I think, relatively high quality because how it was developed, but it's a lead generation using consumers' credit reports to generate the kind of like the lead list. So lenders like to use this. But that being said, because we're talking about credit reports and the use of it, there are some technical requirements that you have to put in place and respect in order to be compliant under FCRA. So it's a pretty narrow. The requirements are pretty tight, and you want to stick with them. So, Champ, why don't you kick us off? What do you think about firm offers of credit? What's your experience on that?
My first experience with this was when I was a little bit greener and more of a newly into the world of compliance and marketing. And at the time, I basically was approached by our head of our lead generation team, and she said, "Hey, we're going to do firm offers of credit, and we're going to send these letters out to these borrowers, and you guys got to figure out how to do it and make it compliant. That's your job. Your market compliance, make this compliant." And so I started with nothing but an ask from a higher up and a template that I didn't know if it was right or wrong, and so I just sort of had to start from scratch and research and figure out, is this template wrong? Who is this? What laws regulate firm offers of credit? Where do I even start? And so that sort of built the foundation, and we got it done. And then a few years later, a little bit more experience, we did it again. And this time we were using a CRM to send out these letters, and they had their own template, and it sort of differed from what I was used to. And so we made some changes. We requested some changes to be made, and we found a good compromise, and it worked out well. So that's my experience with that.
Yeah, and same here. It's just they're like I said, it's all it is a direct mail piece. I mean, it could be more than that. But let's say it's all it is a direct mail piece, but it's turbocharged insofar as the compliance requirements. But explain to me one of the things that we have to stand at the end of the day. We're using credit reporting information, right? And as you know, credit reports, I always say, are pretty much held very close to the vest by all consumers at all times. Most of your consumer complaints anytime in mortgage bids are going to be related to an unauthorized pull of credit. So I've had to argue permissible purpose many, many, many times and explain how it works to consumers, regulators, and of course internally. But here we're looking at credit. The borrower has requested and we can use credit. It's still a permissible purpose, right?
Yes. And as far as those, we all know that if you're in this space, you're probably familiar with how there seems to always be some borrowers out there that make the argument that you pulled their credit without authorization, which, that's a whole different conversation. That typically the loan officer asks for permission as part of the operating procedure to ask for permission. That's just a good business practice. Even though you're taking an application, it should be implied. But no, this is a little different. Like you said, this is the one area that the FCRA allows for you to access this consumer information from Experian or Equifax or TransUnion or whatever without the borrower initiating it, or without the consumer initiating a transaction from you. So the FCRA allows a framework to which you can access this report to use for marketing purposes if you have this permissible purpose. And like you said, that permissible purpose is offering this firm offer of credit. So if you gain this consumer report and then you do not then follow through and then make that pre-screened offer or firm offer of credit, then you're in violation of the FCRA. as it's
Yeah.
written.
So, like I said, it comes with strings. Now, let me ask you something, because you're marketing it. I'm marketing compliance. I get it, but you're really kind of in the crosshairs of marketing. So, why would someone want to do a firm offer of credit versus a non-firm offer?
Yeah, that's a great question. So it's a way, it's again, it's a marketing tool. So you put it in a direct mail, or you could do it electronically too. You could send out emails to people and make a firm offer of credit. But a lot of people, when most people think a firm offer of credit or pre-screened offer, we've all received these in the mail. It's not just for mortgage lending; it's for credit cards. It's even for insurance. So maybe just a policy that you're approved for. So it's as a consumer, you get this mail and it says you're basically pre-approved for, and that's where the marketing comes in. It's like, what are the key criteria that you're approved for? Hey, you got a loan amount up to XYZ amount. Maybe it's a range of minimum of X to Y, and or it could be you're eligible for a cash out refinance or whatever and that's what's grabbing the consumer's attention. And you could, if you so wish, you could put the APR or the interest rate. But then that comes with a whole other list of technical requirements. So it's not like a typical solicitation of, hey, come apply for a loan. Maybe somebody has doubt in their mind that they'll get approved. You're already approved, Mr. Customer. So that's the benefit from a marketing standpoint.
Yeah, and I think there's an upside to that. Now, I want to be clear, and correct me if I'm wrong, but it's not like we are actually getting their credit score. This is more a way that the lead was cultivated by probably giving some criteria, as you kind of mentioned. Make sure the credit score is in excess of 680 or whatever it is, right? Something like that, and then they put on a list, but we don't know the credit score. Is that right?
That's my understanding. Is this permissible purpose through the FCRA? You can access some information, and it's limited to, as far as the individual consumers information, you're able to get their name and their address, basically. So enough to send them a letter. As far as you don't have a full, because it's like you said, you don't pull a full credit report. You just have the criteria you're looking for. Maybe you're looking for a certain FICO score. So that's one example.
And so I want to talk to you then about the firm offer of credit. And a firm offer of credit sounds like it's already an official offer. It's more significant than if we just did a random, someone randomly called you for a loan. Something is in there that is a firm offer, and we have to give the loan. So is it true that we have to, once they call in, we just sign the check, or is it conditional, insofar as, the offer? I mean, it's firm, but it's conditional. Is that right?
Right. Yeah. It is a real, and what you said there, it made me think of something. It's got to be an actual offer of something of value, because if it's just a marketing tactic and there's no valuable offer you're actually making, then you lose your permissible purpose again. But do they just have to sign the check and no questions asked? It's a firm offer. It is what it is. It's just free money. No, that is not the case. There are conditions, and there are criteria. There's you have to meet certain criteria, and the criteria are laid out in the offer itself, on the principal documentation, on the marketing solicitation. And oftentimes that criteria, it's all based around credit, right? So we have, the lender has to be able to verify the information provided on the application. That's one thing that's required. Then it is contingent upon your continued compliance with your creditworthiness. So the creditworthiness criteria used to select you for the offer, that still has to be maintained. So if you have a certain FICO and a decent credit standing at the time that the consumer report was acquired, and now suddenly you've defaulted and you've bought a bunch of debt, and your credit profile is different materially, then you may not, then the offer does not stand. And then the third thing is typically the verification of acceptable property as collateral, such as in the case of like an auto loan or a mortgage, something like that. So you have to get the appraisal.
Yeah, you're right. Yeah. And that's interesting you say that. I always talk about mortgage context, but you're right. There could be other contexts of marketing. Surprise. But for
Right.
me, yeah. So what you're looking at is, what I'm hearing is, can't budge on the credit unless they tank. In other words, and I would even go so far as to say the credit criteria that's used for pulling the credit can't be changed on them, right? If they responded within a reasonable time, we still have to honor it, even though maybe we change our guidelines or investor change. It doesn't matter. We have to honor the purpose. Like you nailed it. The permissible purpose is going to be tanked if you don't honor the credit, the credit box, if you will, that you used to initially pull the leads for firm offer. You're right. I think it's income. Probably you have to be able to prove income, and if you don't got that, sorry, you don't get it. You get property, don't get that. If it, again, the credit doesn't come in, you can deny it for that. And yeah, you nailed it. It's like if the credit's going to be bad compared to when it was, and they on their own have affected their credit different than the criteria we used, you're right. So I think that's out. So it is a firm offer, but it's conditional. But you got to know the distinctions and how that applies in your world. Okay, that makes sense. So let me ask you this something, and this could be happens in the real world. Underwriter looks at the credit report, sees something that they don't like, and let's say they pull another credit card at a store or something, not a big one or whatever. So it doesn't really affect the credit box, the FICO score, something that originally was part of the criteria, but the underwriter still doesn't like it. Is that something that is material enough, do you think, to not to deny the loan?
So that's, having been a loan officer and account executive, and kind of gone are the days where you take the file and you're somehow able to talk to the underwriter, and the underwriter's looking at it, explaining to you why they're going to deny it because they don't like this or that. That they see that it's the human element comes in, and they start thinking, well, this is a higher risk than it technically meets criteria, but I don't like it, so I think it's too risky. We're going to deny it. You can't do that in this situation, because then you've just violated. It's a firm offer. It's based on certain credit criteria. There's still it's still within the parameters of what you initially made the offer upon. So therefore, you cannot do that. Now, if it would be different if now you're full credit and you see that the borrower now has a bankruptcy that wasn't there at the time when you made the offer. That is a material difference in order to deny it legally under the FCRA.
Yeah. So it's got to be really obvious and really material, I think. I mean, if there are gray areas, as I always say, check with your compliance professional and they'll tell you what you can do. Okay, so we know that we can't do much with credit, or that that's something we should have to be careful with. Now, let's switch gears. Let's talk about the disclosure language in the letters themselves. And so I know there's certain language that needs to go in this specifically firm offer. What can you tell me about that?
As far as like the compliance component to this with the Fair Credit Reporting Act, well, you also have to list out your criteria that you're basing the offer on, and then the next thing that's going to be on that first page, visibly on the actual letter, is going to be what's called the short notice, letting them know how to opt out of a pre-screen notice. Okay, so the short notice, it's actually spelled out. If you look into the Fair Credit Reporting Act under whatever subsection talks about firm offers, it tells you exactly how to do it. And you can go and read it and then just piece this out yourself, or you can look how others have done it, and then it all just follows along. So it's basically you have to let them know that that they can stop receiving pre-screened offers of credit, and how they do it by calling a toll-free number to opt out of getting pre-screened offers. And then you basically so you tell them how that they can opt out and how to do it. Well, I'm sorry, you tell them that they can opt out, then you provide them with the phone number to do so. Some people go a step further and provide the website, because it's like www.optoutprescreen.com. And then you have to let them know of the long form notice. So there has to be a more information in a longer format on a different page or elsewhere in the on the document. So and that's done, and then they ask you to put the typeface. It has to be larger than the typeface used for the rest of the document. It should be in a different color. And it should stand out from the other type, such as it should be bolded, italicized, or underlined, or it could be all the above. I like to put it all in italics and blue ink in contrast to black, and then underline and bold the pre-screen opt-out notice that's in all caps. And so that's the short form notice. And then if you flip it over to the next page, or it's on the second letter page of the document, it's the long form notice, and there's a little bit more there. And it basically says, and again, this is spelled out in the FCRA rules, this pre-screened offer of credit or insurance or whatever it is you're offering is based on information in your credit report indicating that you meet certain criteria. The offer is not guaranteed if you do not meet our criteria, including providing acceptable property as collateral. And if you do not want to receive pre-screened offers of credit or insurance from this and other companies, call the Consumer Reporting Agency. So that would be like your Experian or your Equifax, toll free, and then the toll free number is provided, or write Equifax at such and such at whatever the address is for Equifax. And that's the long form notice. And again, that is completely spelled out for you in the guidelines.
Yeah, and I think, and that's always the That's almost a buzzkill when it comes to marketing. It's like suddenly we're bold, sometimes different colors, different kind of like, we don't want that. It's going to throw them off. Like, well, that's what we dealt with when you deal with from offers of credit. There's certain things that you have to do that maybe aren't as marketing savvy as the chief of marketing would like. So that tends to be the case. Is there anything else you want to talk about on from offers of credit here?
Yeah, I think one interesting thing to talk about, and this is where some of the lawyer stuff comes in, and talking to your legal team and some of that gray area. I think it's just one of the more, I guess, interesting aspects is like you have to let that. How long do we have to honor this offer that we've made? You know, is it what's? I think the law says the offer must be on the table for a reasonable time. So what's reasonable time? And I think back when we were doing it, I feel like we, if I'm remembering correctly, we kind of hemmed and hawed over is 60 days long enough? Is 90 days? Should it be 120? And I don't remember if we landed on 90 or 120 or longer, but you have to think about the medium in which you're doing it. So if you're sending it out via mail, then you allocate for the time it takes to basically from the letter to go out in the mail. How many days does it take for the consumer to receive it and open it? Is it going to sit on their shelf for a week, or sit on their counter for a week, and then time to think about the offer, and then respond and say yes and mail it back to you, and then the time involved for the mail to come back to your office and get processed. So there's a lot of time there. So I don't know if 30 days is reasonable. I think there could be maybe. I mean, from you and your experience, is that's probably an argument to be made from a lawyer in a lawsuit that they didn't have enough time to respond. It should be honored.
Yeah, I think it's a good question because that's the one thing they don't have is at the end of the day, like, look, we have to lock in the credit criteria, and that's what we tell them. So you have to commit to it, even if our credit criteria changes. Let's say the investor says we no longer make loans at 680, it's now 700. You still got to honor the 680 because that's what you pulled it on, right? That was that's how you generated your lead and pulled so-called use the credit information. But how long do you do? That's a great question. Someone asked, and I don't know the answer to that. I don't know if it's 90, 60. My unofficial opinion, I think 30 is too short. I think 3 years is too long. So somewhere I'll give you the lawyer answer. It's somewhere between 30 days and 3 years. So thanks for joining us again and giving us your insight, being the marketing warrior when it comes to compliance, and that says a lot, as we know. So any other any closing statements?
No, I'd say just if you're a lender out there and you maybe you've never done these before, or you're thinking about trying and you don't know how to do it. If you have any questions, I'm sure that Ray or I would be happy to help you with that. And if it's not that hard once you get a little bit of guidance and you follow the steps, it's doable. So don't be intimidated by it and give it a shot.
That's a great point. All right. Well, and thank you for that. And thank you, everybody, for listening to another Loan Risk Advisors Compliance Rundown, this time on Firm Offers Credit. Thank you, Champ, for joining us. And I look forward to seeing everybody else at the next Loan Risk Advisors Compliance Rundown. Thank you.